This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, August 6, 2026, and this is the New York pre-market. Now, let's get into it. Healthcare is green while the rest of the market bleeds. We are seeing a textbook flight to safety play execute in real time, with the Dow Jones Industrials bucking the trend, while tech and energy sectors dig deeper holes. As of 9:19 ET, the S&P 500 is clinging to support at 769.79, but underneath that average lies a fracture between defensive strength and aggressive risk-off positioning. Opening the economic calendar for Thursday, August 6th, we have three key data points that will influence intraday volatility. First, initial jobless claims arrive today, offering fresh insight into labor market cooling. Second, we get the latest reading on productivity and costs, a critical metric for inflation expectations. Finally, wholesale trade data provides a snapshot of supply chain health and inventory levels. These figures will test whether the current defensive rotation is justified by hard data or purely sentiment-driven.
With the yield curve deeply inverted and inflation stubbornly above target, any surprise in productivity or claims could trigger a rapid reassessment of rate policy expectations, amplifying the volatility we're already seeing in pre-market flows.
Here is the snapshot as of 9:19 ET. SPY sits at 769.79, down 0.2%. Triple Q is heavier at 717.3, off 0.9%. Diamonds holds firm at 542.81, up 0.44%, while IWM slips to 299.77, down 0.64%. In the sectors, the healthcare sector leads with a 1.27% gain, while the energy sector lags at minus 2.7%. The VIX is at 16.5, up 0.64 points. Let's dive into the mechanics of this divergence. The market is reacting sharply to post-market earnings reports. Unity U has surged 14.3% on a blowout quarter, while CELH plummeted 12.2% on a miss. Additionally, Datadog DDOG dropped 14% despite beating estimates, raising valuation alarms. How is this reshaping the risk profile? It's a stark display of sentiment bifurcation. The 14.3% move in Unity suggests capital is willing to pay a premium for confirmed growth, but the simultaneous 14% hit to Datadog, even on a beat, shows that good enough is no longer sufficient. Retail and institutional money are fleeing anything that looks like overvalued speculation, funneling instead into the safety of the healthcare sector. The put/call ratios aren't spiking because the VIX is calm at 16.5, but the directional flow is clearly bidirectional. Long defense, short tech.
And that's the danger. You're describing a flight to safety, but look at the VIX at 16.5. It's suppressed, complacent. The market isn't priced for the reality that the energy sector, is crashing 2.7% while the two-year yield sits at 4.2%. That inversion is a trap. The sentiment here isn't healthy rebalancing. It's panic masked as prudence. When the yield curve screams recession and the VIX whispers silence, the safe havens become the most vulnerable when the tide turns.
Let's ground this in the fundamentals. Unity's surge isn't just sentiment. It's a validation of unit economics in a high-rate environment. But the Datadog crash tells us that the multiple compression is accelerating. Investors are actively deleveraging mid-cap software exposure. This isn't noise, it's a structural repricing of risk. The market is punishing companies that rely on future cash flows rather than current profitability. That's why CELH is down 12.2%. It's a consumer discretionary proxy for weakened demand elasticity.
So we have a market punishing growth multiples while rewarding operational excellence in healthcare. Let's look at the charts to see if the technical structure supports this thesis. SPY is at 769.79, just 28 cents above yesterday's low of 769.51. Triple Q is at 717.3, hovering near its 10-day low of 716.92. Grid, what is the technical implication of this precarious positioning?
SPY is technically exhausted. Trading at 769.79 means we are essentially kissing the floor established yesterday at 769.51. There is no buffer here. Yesterday's high was 776.85, and we've lost nearly all that ground. If we lose 769.51, we enter a vacuum zone with no immediate horizontal support until we look back at the 760 level psychological marks. Meanwhile, Triple Q at 717.3 is trapped in the lower quartile of its 10-day range, which spans from 661.14 to 728.54. The lack of volume on any bounce attempts suggests sellers are still in control. This isn't a consolidation, it's a slow bleed.
Grid, you're noting the fragility of the 769.51 support, which aligns with Pulse's observation that the rally is lacking breadth. However, Apex sees a nuance here. The diamond's strength at 542.81, up 0.44%, provides a counterweight. The S&P 500 is being dragged down by the weight of Triple Q, but the Dow is holding the line. Does that mean SPY support is more robust than it appears, or is diamond simply lagging the correction?
No, Apex, that's a lagging indicator trap. Diamonds includes heavy industrials and financials that react slower to tech-driven corrections. Using diamonds to validate SPY support is like using a speedometer from a car that hasn't hit the brakes yet. The technical reality is that SPY is failing to hold its own lows, and Triple Q is actively breaking structure. The floor at 769.51 is thin ice.
I agree with Grid on the fragility, but let's look at the macro driver behind this technical failure. The 2-year yield is 4.2%, and the 10-year is 4.63%. That minus 43 basis point inversion is the engine crushing these support levels. When real rates are this high, technical support levels become liquidity traps. Buyers step in at 769.51, only to be stopped out when the macro data confirms that growth is stalling. The VIX at 16.5 is deceptive. It's low because everyone is waiting for the next shoe to drop.
Shifting gears to the specific earnings drivers. Unity U is up 14.3%, while DDOG is down 14%. CIPHER, walk us through the fundamental divergence here.
The divergence is stark. Unity U reported a Q2 beat and gave a bullish outlook, resulting in a 14.3% gap up. This is pure fundamental validation. They delivered growth. Contrast that with Datadog, DDOG, which also beat but crashed 14%. Why? Because the market has raised the hurdle rate. DDOG revenue growth couldn't justify the multiple in a 4.2% yield environment. Meanwhile, CELH missed entirely and fell 12.2%. This isn't random, it's a ruthless filter. Capital is flowing out of speculative consumer plays and undervalued SaaS and into proven, efficient operators.
And that flows directly into sentiment. The fear part of the fear and greed scale is manifesting in the rejection of DDOG and CELH. But notice the absence of panic in the broader index. The VIX is stable. This suggests that smart money is not panicking. They are reallocating. They are taking profits from high beta tech and parking them in the healthcare sector, which is up 1.27%. It's a quiet exodus, not a chaotic exit.
Connecting these dots, CIPHER highlights the fundamental shift toward efficiency, and Pulse confirms that capital is rotating into the healthcare sector. But Grid, how does this rotation impact the technical picture for the healthcare sector compared to the broader market?
Technically, the healthcare sector is showing relative strength, up 1.27%, which stands in sharp contrast to the 0.9% drag on Triple Q. However, I would caution against calling it a breakout. We haven't seen a decisive candle close above key resistance levels yet. It's holding its ground. Conversely, the energy sector is down 2.7%, showing clear distribution. The technical message is simple: long healthcare. Avoid energy and tech until Triple Q reclaims 720.
The energy sector is down 2.7%, a significant underperformer. SPECTER, you mentioned earlier that this might be a trap. What is the risk profile here?
The risk is that the energy sector's 2.7% drop is being interpreted as a buying opportunity by some, when it is actually a reflection of demand destruction fears. With GDP growth at 1.5% and unemployment at 4.2%, global growth is slowing. Energy is a proxy for global activity. The fact that it's lagging while the healthcare sector leads confirms the recession hedge trade is active. Furthermore, the VIX at 16.5 is dangerously low for this level of sector divergence. If the VIX spikes above 20, as it did recently, the correlation between equities and bonds will tighten, and the energy sector could see accelerated selling as margin calls hit leveraged positions.
CIPHER, does the fundamental data support a slowdown in energy demand?
Wholesale trade data coming later today will be crucial. If inventory buildup continues alongside softening sales, it reinforces the demand destruction thesis. Currently, the data shows mixed signals, but the price action in the energy sector is telling. Institutions are reducing exposure. There is no fundamental catalyst in the next 48 hours to suggest a rebound, until we see a stabilization in crude or a positive surprise in industrial production. The energy sector remains a liability.
So the consensus is clear. Defense is in, offense is out. But let's look at the small cap index IWM at 299.77, down 0.64%. Grid, how does the small cap technicals compare to the large cap SPY?
IWM is at 299.77, sitting right on the edge of its 24-hour low of 299.75. It is essentially flatlining. Unlike SPY, which has a clear low at 769.51, IWM is trapped in a tight range with low volume. This indecision suggests small caps are waiting for direction. They are not leading the decline, nor are they leading the recovery. They are bystanders, which usually makes them vulnerable to sudden sweeps in either direction once a trend is established.
We have a lot of data. Let's wrap up with a synthesis of the current landscape.
Let's tie this together. Grid identified that SPY support at 769.51 is fragile and QQQ is technically exhausted near its 10-day low. CIPHER explained that this technical weakness is driven by a fundamental repricing of risk, where Unity's fundamentals are rewarded while Datadog and Celdine are punished. Pulse confirmed that sentiment is shifting via a quiet exodus from tech into healthcare, reflected in the VIX staying suppressively low at 16.5, despite the sector rotation. SPECTER warned that this low volatility environment, combined with an inverted yield curve, creates a false sense of security that could lead to a sharp VIX spike. The directive is clear. Preserve capital in defensive sectors like the healthcare sector, avoid earnings-vulnerable tech, and monitor the 769.51 level on SPY as the linchpin for broader market stability.
To summarize, the market is in a flight to safety mode, with the healthcare sector leading and tech, QQQ struggling. Technical support at 769.51 on SPY is critical, while fundamental earnings disparities are driving stock-specific volatility. Tomorrow, traders will watch for productivity data and how the market reacts to continued earnings flows. This has been the ShadowQuant Equities edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.